stay stuck, ripe, and rotting. I'm Wade Perry. I'm your host, and I'm here to help you thrive in every corner of your life, whether it's mindset, business, or fitness. Together, we'll unpack the lessons, insights, and game-changing strategies to keep you learning, growing, and pushing forward. Today, it's my absolute pleasure to welcome back one of my dear, dear friends, Jared Hamilton. Jared Hamilton has been with Cherry Creek Mortgage now for, I believe, Jared, helped me out, close to 30 years,
Yeah, just a little bit over 30 years and a
which is
couple months
impossible because you're only like 35 years old. But, you were
in
a
my
child
dreams.
genius, I guess.
Yeah,
Um,
right.
So today we're going to pack with some insights that can help you in the mortgage industry, the real estate industry, and get a feeling for where we were in the third quarter, where we are today, and some really great tips from Jared about what you should or shouldn't be doing now if you're a buyer. So without any further introduction, Jared, you ready to go?
I'm ready to go, and thank you so much for having me, Wade. I'm really excited.
Awesome. Well, Jared, we're now the third quarter's in the books. We've had about 3 weeks to digest all of the information and look back and try to make sense because it's really hard when we are in the middle of it all to make sense of it until we have a little rear view mirror perspective. The third quarter brought a lot of action in the mortgage industry, and it'd be great if you could kind of share with us where were rates on July 1st and where did they end up on September 30th?
Yeah, so you are right, Wade. There has been a lot of action in the mortgage industry in terms of interest rates, and anytime we are transitioning, then we're going to get a little bit more volatility. So the beginning of the third quarter, interest rates were in a range of somewhere between about 6.75 to about 7%. There were some days where it was maybe a little bit less than 6.75. So, but that's about where that range was, the very beginning of the first quarter or the third quarter and the start of that. Yeah.
And at the end of the third quarter, about
Well, at the
September
end of
30th,
yeah,
where
well, at
were
the
we
end
at
of the
the end?
third. Yeah, well, yeah, sorry to step over you. At the end of the third quarter, we were about the same. Interest rates actually were a little bit closer to 6.5 at the very end of the third quarter. But now, even though, we've just started that fourth quarter, rates are a little bit closer to 7. So the trend has actually been moving up here a little bit.
So on the surface, Jared, if you went away on for the 4th of July and you got on a boat and went sailing for 90 days and you came home, you'd say nothing changed. But in reality, that is not the case. Mortgage rates were kind of a bouncing ball during the quarter. Can you elaborate on where we were, where'd we go, and obviously we're back where we started. So share with us what happened during the quarter.
Yeah. So, what happened during the quarter is we saw a lot of economic data, and interest rates are 30-year fixed rates are influenced by what the market perceives as where the economy will be going. And so, in the beginning of the third quarter, we were seeing economic data that was showing that inflation was beginning to quell, and that inflation had been trending lower and remaining there for a period of time. It was also showing that the jobs market or the employment data was also showing some signs of weakness. So within the third quarter, it was perceived by the market that the economy was beginning to slow. The Federal Reserve could begin moving from their very heightened stance about trying to quell inflation, because that's what the Federal Reserve was trying to do, is trying to bring down inflation and to keep that from becoming a problem later on down the road. And it was looking like the Federal Reserve was going to be moving from a more stringent stance to beginning to become a little bit more accommodative. And then things ended up reversing themselves just because inflation reared its ugly head again.
So what happened in so if I'm hearing you right, everything was trending towards a weaker economy, a slower economy, and then all of a sudden we got a couple of pieces of economic data that just completely changed that direction and sent rates back up. What were those pieces of data that came out?
Well, and it was a combination of two things. It was not only, I mean, all the economic data was showing some signs of job market weakening and also inflation under control. And then the Federal Reserve did meet, and they eased credit by a little bit more than what some were expecting. They eased the Fed funds and discount rate, which is money that is overnight money. So, Wade, if you were Bank of America and I was the Federal Reserve and you needed to meet your overnight reserve requirements, you would be borrowing at the Fed funds rate. And so that's what the Federal Reserve was tweaking there. It's overnight money. It doesn't really affect, I mean, it has an influence on 30-year fixed rates, but it's more in the longer term. So Federal Reserve eased credit a little bit more than what the market expected, to try to become a little bit more accommodative to keep the economy from getting much worse. And
Mhm.
then a couple days after that, we saw CPI come out with a little bit higher than expected. But the big deal was is that the jobs number on that's introduced on the first Friday of every month showed that there were more jobs added to the economy than what was expected. And that just reversed the trend, because now what the market was perceiving is that, okay, the Federal Reserve became more accommodative to help the economy. And now jobs were a little bit stronger than what were expected. So now there's a lot more worry about future inflation. So did the Federal Reserve uh, act too quickly, and will inflation rear its ugly head? And that's why we saw mortgage rates jump back up.
Okay, so really we were trending in the right direction. Or I should say we were trending to lower rates. I don't want to call the direction right or wrong, but we were trending to lower rates. And then we really had just one piece of data that spooked the market to think, gee, are we still in a really inflationary environment? And maybe we should be on defensive and keep these rates high. Um, am I close on that?
Yeah, you're close. That, along with the Federal Reserve being more accommodative and making it easier for banks to borrow money, cheaper for banks to borrow money, to lend that out to increase the velocity of money, and spur the economy. So it was those two
Okay.
things.
So I know I'm talking on behalf of thousands of realtors and consumers when I express a wee bit of confusion as to why rates skyrocketed. But I think you put it really, really well that yes, we're going in the right direction, but that one piece of data spooked people. Um, Let me ask you this. Let's shift gears a little bit because we are at 7%. And I think I know the answer to this, but I think there's a lot of people that are out there listening that want to know the answer. Is there much intel out there that addresses what might happen in the economy or with mortgage rates if one presidential candidate wins versus another?
Yeah, that's a great question, and it's something that I hear all the time. Um, in my personal opinion, the financial markets are massively complex, and it's not just
Mhm.
from a locally or within the United States. I mean, it's a global financial market. And so there are so many things that influence interest rates. Does the next political, or does our next president have an effect on interest rates? Sure, there's an effect there. But the reality is, it's not much. In my opinion, there's influence, but it's also, these things are so complex. There's a lot of consternation that goes on, like, okay, who's our next president going to be? But in my opinion, the God's honest truth, the winds of the economy will blow a certain way, regardless of whether or not it's one party or another party. Now, over time, there's going to be things that get implemented by a particular party or president, and that will have an effect. But most of the stuff really is just all speculation, and I really don't think that it's going to have a major effect on what happens with interest rates. And
Yeah,
and
I
time
think
has shown that.
yeah, if you go back through history and you want to look at, obviously, this is rear view mirror stuff, and we look at did housing do better under a Republican administration or a Democrat administration? And the answer is a negligible difference of probably less than a quarter percent. And the same goes for the financial markets. The stock market doesn't historically behave differently one versus the other. Are I'm guessing you might feel the same way I do, that what's going to happen to interest rates is it's dependent on a lot of factors, obviously, and we can't cover everything, but it really kind of comes down to what people like you and me and all the people that we know, and what do they do with their paycheck? Are they out there spending? Are they going on trips? Or are they holding close to the vest? And that really is how the consumer deploys their capital, helps determine what's going to happen in the economy. And obviously, how people deploy their capital is somewhat dependent on where interest rates are. And I don't think I've ever believed that who's president is going to change the mortgage market or the real estate market. Do you feel the same way?
Generally, yes, I definitely do. And there's influence. And the economy will just move in also general directions. I mean, it's trends, and the economy has been trending positively. There will be a point in time, regardless of who's president, regardless of uh, which political party is in Congress, it will trend down. And so it just goes
Yeah.
up and it goes down. And then, there's going to be maybe some other things that influence it that might exacerbate those. And I generally do believe, though, that we are going to be going into in the future here, because the economy has been trending up, that we will see weakness in the economy. And I think interest rates will begin trending lower into 2025, and also into 2026. I just think that's going to happen. There's other things that might change that, but just based upon trends, that should happen.
I couldn't agree more. I saw a piece by Elliot Eisenberg. I know you know who he is,
Yeah.
a very
Bowtie economist.
well-known economist, and one of his tidbits, I think it was last week, was that one out of every seven, roughly 16% of American households polled, expressed a deep concern over their ability to pay their bills for the next 90 days. And that was the highest number that they'd ever recorded. The next closest high number was actually April of 20 at the onset of COVID, and it only hit 14%. So I think that while we can look at the stock market and Fortune 500 companies that are doing well, I think a lot of that has come from efficiencies. And I think overall, there are some elements of the consumer base that are doing fine, but I think that on the whole, there's a lot more people that are maybe struggling, that leads to some economic weakness that we'd like to think leads to more favorable mortgage rates. So we've talked about how mortgage rates, they've been bouncing up and down for many months now, and who's in the White House really doesn't have any bearing on how the housing market or how the mortgage rates are going to behave. So let me ask you a question, because this is, I believe that this morning it was announced after September's um, real estate data, the number of homes that had closed, that we are actually on pace for the least number of home closings since 2010, 14 years. And it's still 3.8 million homes, which is a lot. But to put it in perspective, to have the lowest number since 2010 kind of makes you wonder, is now a good time to buy a home? What says you?
Yeah, well, and that's great point. Yeah, transactions are low, and one of the reasons transactions are low is because of these higher interest rates. And usually, when people are asking the question, and this, hey, what's going on with interest rates, is because they're trying to get to, there may be one, they just could be curious, but a lot of times it's like, well, are interest rates going to go down? Is it better to buy now, or is it better to wait for interest rates to go down? How do I time my purchase decision based upon interest rates? And
Let me interrupt 1 second. I hear that all the time. When is the best time to buy a house? Like they're trying to time a stock or something.
yeah,
And so jump back in and share with us, is there a best time? Is there any validity to try to time the market?
I don't think there's any validity to trying to time the market because um, rates are going to be where they are and they move on a daily basis. And we saw people jump into the market the very beginning of, or right before the Federal Reserve moved because hey, rates are going lower, and then basically 2 weeks later, rates were up, and they're trying to time things, and it wouldn't have worked out in terms of timing. And the same thing goes also with real estate. People will also maybe say to you, Wade, okay, is now a good time to buy? And I believe that it's a good time to buy a home if it makes economic sense for you and you can afford the payment. And when it comes to interest rates, the reality is that if you buy a house and interest rates go down, you can get the better interest rate. If you buy a house and interest rates go up after you buy the house, you already got your interest rate. So it's a heads you win, tails you win decision when it comes to buying a house if you can afford that payment and if it's a good economic decision. And that's what we need to get to. If you want to wait for interest rates to go down or up, what I always tell my clients is, you know what? That's gambling. You want to go to, if you want to gamble, go to Las Vegas. It's way more fun and they give you free drinks. But if you're wanting to buy a house, then we got to just figure out what's going to be appropriate for your overall budget. How does interest rates, where they are today, affect that? Is there maybe a strategy that we can try to deploy in case rates come down to make it a better economic decision for you that we can tweak it and know what the pros and cons are? But we just find out if is buying a house a good economic decision for you today and what can you afford, and let's go uh, structure things for what you can afford.
I think that is absolutely spot on sage advice, and maybe you'll agree with what I'm going to share with you. But um, there's two parts to this. It was once said to me, when's the best, when was the best time to buy a house? And the answer is yesterday. When's the second best time? Today. But that comes with a caveat. And what I like to share with people, and maybe you'll agree with this or not, is, and it's piggybacking on your sage advice, which is if this makes sense for you in your economic picture, you can afford the payment, et cetera. I will tell people that if you know that you're going to live in a certain general area, I'm not talking about, Centennial versus Inglewood, but if you're going to live in the greater Denver area for at least 3 years, you should buy a home if you can afford it. I mean, if you have the down payment
Yeah.
and the payment can fit into your budget, if you know you're going to be in the general area for at least 3 years, I can look you in the eye with 99% certainty that you will benefit from appreciation, from tax advantages, and in 3 to 4 years, you're going to look back and thank me. If you think your time period is less than that, may only be here for a year or maybe 2 years, would you still think it's a good time to buy, or would you say maybe not?
Well, yeah, I would say maybe not if because then that's speculative. And I mean, unless
Right.
your thought process is, hey, I can move and I'm going to keep the house and rent it, as an investment property,
Sure.
then that's maybe a
Sure.
different decision. But yeah, I mean, um, time is helpful, and then that takes away some of the volatility, that could happen in the market.
Absolutely. In fact, you and I talk every week, and we talk a lot about economics. We talk a lot about rate. And one of the questions that you always bring up to me is, wait, if you were to go back in time to 1981 and rates were at 17%, would you still buy a home? And my answer is always absolutely, because I look at what the house would be worth today and I got to live in it and all those other benefits. So your guidance is always spot on in that arena. So I think it's safe to say that people should not get wrapped up in a quarter or a half a point difference in rate, because there are so many more reasons why people should own a home if they're going to live in a particular area for a while. Obviously, the tax advantages and the appreciation, and not having somebody raise their rent every time the lease comes up. Overall, are you bullish on housing over the next year or two?
I am. And Wade, you had brought up the thing that the amount of transacting that's going on is way down, and that is influenced by interest rates being higher and values had gone up. But what that does, economics is all about supply and demand. And so what we've done is, with less people transacting, there's still people who are getting out into the job market to buy their first home. They call this birth death ratios or family formations. That's still happening, and so and people are still having life events. People are still moving in and out of the Colorado area, and it's just causing some pent up demand. And so that's as soon as rates, when rates go down, or people just get used to where rates are, there'll be more transacting going on. And so that bodes well overall for interest rates. I'm bullish on housing because people still need a place to live. There has been fewer new homes created, so fewer homes built than is needed over the last 10 years. So there's a supply demand issue that's happening there. There's been large organizations buying rental properties because they believe it's there. So that's taking housing off the market too. So there's all these fundamentals that are happening that just leads me to believe that housing is going to be just fine. Still, you can't go blindly into things by any way,
No.
shape, or form, and time solves it. Housing has never gone to zero. Everybody who has bought a house and kept it for 10 years has made money. There's never been, Wade, do you know that there's never been a 10-year time frame where over on a national basis where housing has remained low? If you take the high, and then there was a little bit of a turn, and it was all around, the 2028 housing crash. But it always come back around and sold for more money than ultimately what someone bought it for. And it's just
I,
about
I
time.
I do believe you on the 10-year. I wouldn't even be surprised if it was on the 7-year. I actually, until this last spring, I believe I had gone back and looked at my own lifetime. And in my lifetime, there had only been, I believe, 3 times that real estate had actually gone down over a 3-year period. And so that's hence why I say, if you're going to stay put. So I absolutely believe exactly what you believe, that because we've had such a reduction in the number of homes sold, people are still getting married, people are still having babies, they're still feeding those babies, so they're growing, they're going to need more space, and that is pent up demand. I even know of a couple that we helped this last spring who have been divorced for almost a year, still living in the same house because of the rate. And so I think that once we see rates come down, as I believe they will in 2025 due to economic weakness, and we will see that demand get deployed, and it will be a very, very good year. My counsel to buyers would be, if that is the case, if buying a home is in your goals, your future look for 2025, don't wait. Do it now, because when we see rates get down anywhere in the fives, 5.99, and stays there for a couple weeks, it's going to be combat warfare and it's going to be hard to compete. Whereas now you have the opportunity to compete without much competition. You might be able to get the seller to provide a rate buy down. You might get more favorable terms. Days on market's going longer. This is a great time to be a buyer because, as you mentioned, we will likely have opportunities to refinance in 25 and 26. Do
Yeah,
you agree?
I do.
Okay.
But I could be wrong. And then if it doesn't go down, you got the best rate available.
Ladies and gentlemen, I'm going to tell you that Jared is never wrong. He's never wrong.
Oh, I'm wrong.
Okay.
Right. No, no, yeah.
We have
Thank you,
both
Wade.
we've both lived long enough to know that we're going to be wrong once in a while.
Yes.
Jared,
Yeah.
I really appreciate you coming on and doing this and sharing your insights every quarter. If people want this more, we might do it every month, but it is invaluable to me, to our listeners, to have somebody with 30 years of experience, not 3 years, not 3 months. This is somebody who has been battle tested, who has been in the fiery furnace of high rates, who has lived through COVID, who lived through the Great Recession of 2008, 9, 10, 11. And so when you need somebody who's going to tell you true, what is the reality of the mortgage market? What is the reality of my personal situation as it relates to making a move in real estate? I cannot encourage you enough to call Jared Hamilton at Guild Mortgage. He has been my personal mortgage advisor for, gosh, 20 years. And our client base absolutely loves you, Jared, because you're a teacher, you're an educator, and you take the time to help people understand. So we're grateful for you and all of your knowledge and your willingness to share. Before we sign off, is there anything else you'd like to share with our listeners out there?
Well, you're very kind, Wade. Thank you. And I really enjoy working with you and your clients as well because they're again come at this educated, and that's really important. Um, no, I mean, I do believe though that we will see volatility. There's going to be, anytime we're transitioning, there's going to be some volatility for interest rates. So, buckle up. It'll be a fun ride, but ultimately everything's going to be okay. I mean, buying a house is a good thing to do financially, and we'll help you through it. And I know, Wade, you'll get your clients to the finish line because that's what you do.
In the end of the day, Jared, have you ever heard of anybody who bought a home and a year or two later said, God, I wish I wasn't a homeowner?
Well, I mean,
I've, I've never
yes,
heard somebody say that.
I
No,
have, yeah, I mean that because stuff sometimes happens, and maybe not a homeowner, but they're on a very, 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 I mean, I just want to be real. On a very rare occasion, there can be a life event but it's something that they didn't
sure.
plan on. I mean, and that's the
Right.
whole thing is that if you want to think about catastrophic, stuff. I mean, I
Yeah,
don't go outside because I'm afraid of something bad happening because odds are low. But
right.
one day that might happen. So,
It might.
but it happens very, very, very rarely, and it's usually on something that they couldn't see.
Exactly. Well,
So,
Jared, again, thank you for being here. We're going to keep collecting our data. And ladies and gentlemen, we're going to bring you this information as often as we find new information to bring to you so that you can make more informed decisions about your real estate. Real quick, Jared, how do people reach you when they want to talk to a personal liability consultant and a professional mortgage advisor? How do they reach you?
yep. Well, they can give me a call at 303-331-4343,
What was
303-331.
that again? What was that
Yeah,
again?
at 303-331-4343.
Awesome.
Or they can email me at jhamilton@guildmortgage.net.
Jay Hamilton at guildmortgage.net. Fantastic. Well, thanks for joining us in this episode of Green and Growing. If this episode sparked something in you, don't forget to like, comment, and subscribe wherever you listen. Stay connected with us on Instagram, LinkedIn, and YouTube for more inspiration and exclusive contact. Remember, life's about progress, not perfection. Keep growing. Cheers to Green and Growing. We'll see you next time. To the latest episode of Green and Growing. I'm your host, Wade Perry of the Perry Properties Group at EXP.